Imagine this. You wake up tomorrow morning, head out to your car, turn the key, and nothing happens. Dead battery. Or worse, the transmission is shot. Suddenly you're staring down a $1,200 repair bill and you need your car to get to work. Or picture this. You're hit with an unexpected medical bill. Your insurance didn't cover as much as you thought, and now you owe $2,000. What do? Could you cover these expenses right now, today, without putting them on a credit card or taking out a loan? If your answer is no, or even maybe, you're not alone. But that uncertainty is exactly why you need an emergency fund. Today, we're breaking down everything you need to know about emergency funds, what they are, how much you should save, and exactly where to keep that money so it's there when you need it most. So let's start with the basics. What exactly is an emergency fund? Simply put, it's money you set aside specifically for unexpected expenses. And I want to emphasize the word unexpected. This isn't money for your summer vacation, a new phone, or holiday shopping. This is money reserved for true emergencies, situations that genuinely disrupt your life and need immediate attention. What qualifies as a real emergency? Well, job loss is probably the biggest one. If you suddenly lose your income, your emergency fund becomes your lifeline while you search for new employment. Medical emergencies can happen to anyone at any time, regardless of how healthy you think you are. One accident, one diagnosis, and you could be facing bills that insurance doesn't fully cover. Then, there are home repairs. If your water heater bursts or your roof starts leaking, you can't exactly wait until next payday to fix it. And car trouble, like we mentioned earlier, can completely derail your ability to get to work and earn money. These are the situations your emergency fund is designed to handle. Now here's the question everyone asks. How much should you actually save? You've probably heard the standard advice floating around, and it usually sounds something like 3 to 6 months of expenses. But let's dig deeper into what that really means, because there's often confusion here. When we say 3 to 6 months, we're talking about 3 to 6 months of essential expenses, not your income. This is a crucial distinction. You don't need to save half a year's salary. You need to save enough to cover what you actually need to survive for that period. So what counts as essential expenses? Your rent or mortgage payment is obviously at the top of the list. Utilities like electricity, water, gas, and internet, especially if you need internet for job searching. Groceries and basic food costs, not eating out, just what you need to feed yourself and your family. Transportation costs to get to work, whether that's a car payment, insurance, gas, or public transit passes. Insurance premiums, because you definitely don't want to let those lapse during a crisis. And minimum debt payments on any loans or credit cards you have, because missing those can destroy your credit. Add up all those monthly essentials, then multiply by 3 to 6. That's your target range. But where do you fall in that range? Your personal situation determines that. If you're in a single income household, meaning only one person is bringing in money, you'll want to aim for the higher end, closer to 6 months. Why? Because if that one income disappears, you have no backup. If you're in a dual income household where both partners are working, 3 months might be sufficient. The reasoning is that it's less likely both of you will lose income at the exact same time, though of course it can happen. And if you're self-employed or work as a freelancer or contractor, seriously consider saving 6 to 12 months of expenses. Your income is probably less predictable, and you don't have the same unemployment benefits that traditional employees have access to. All right, so you know how much you need. Now let's talk about where to actually keep this money, because this is just as important as how much you save. The number one priority for your emergency fund is accessibility. When your car breaks down or your furnace dies in the middle of winter, you need to get that money quickly. This rules out a lot of options right off the bat. High-yield savings accounts are generally ideal for emergency funds. These are savings accounts, usually offered by online banks, that pay significantly more interest than traditional brick-and-mortar banks. We're talking sometimes 10 to 20 times more interest. Your money is completely safe. It's FDIC insured up to $250,000. and you can typically transfer it to your checking account within 1 to 2 business days. Money market accounts are another solid option. They work similarly to high-yield savings accounts, often with comparable interest rates and the same FDIC insurance protection. Here's something really important. Keep your emergency fund separate from your daily checking account. I cannot stress this enough. If your emergency money is sitting in the same account you use to buy groceries and pay bills, you will accidentally spend it. It's just human nature. Out of sight, out of mind actually works in your favor here. When the money is in a separate account, you have to make a conscious decision to access it, which makes you stop and think, is this really an emergency? Now, what about investing your emergency fund? I get this question a lot, especially from people who hate seeing money just sitting there earning relatively little interest. But here's the thing. Your emergency fund should not be invested in stocks, bonds, or anything else that can lose value. Yes, you might earn higher returns by investing it, but you could also lose 20 or 30% of it right when you need it most. Remember 2008? Remember 2020? Markets can drop fast. Your emergency fund needs to be guaranteed accessible at its full value, not potentially worth less when an emergency actually happens. So how do you actually build this fund? Because let's be honest, saving several $1,000s can feel completely overwhelming, especially if you're living paycheck to paycheck right now. Start with a small, achievable goal. Don't focus on that full 3 to 6 months right away. Instead, aim for $500 or even just $1,000. This might not cover every possible emergency, but it'll handle a lot of the common ones like a minor car repair or an urgent care visit. Once you hit that first milestone, aim for the next one. Maybe $1,500, then $2,000, and so on. The best way to build your fund is to set up automatic transfers each payday. Let's say you get paid every 2 weeks. Set up an automatic transfer of $50 from your checking account to your emergency fund savings account the day after each paycheck hits. You'll barely notice that $50 missing, but over a year, that's $1,300 saved without you having to think about it or exercise willpower. Treat this transfer like a non-negotiable bill, like your electric bill or your rent. It's not optional. It's not something you do only if there's money left over at the end of the month, because let's be real, there's never money left over at the end of the month. Pay your emergency fund first, then budget the rest. Whenever you receive a windfall, like a tax refund, a work bonus, or even a birthday check from your grandmother, put at least a portion of it toward your emergency fund. You don't have to contribute all of it, but if you can put even half into your fund, you'll reach your goal so much faster. Consider cutting one unnecessary expense, just temporarily, while you build your fund. Maybe it's a streaming service you barely use, or eating out one less time per week. You don't have to live like a monk forever, but a few months of small sacrifices can jumpstart your emergency savings significantly. Now let's talk about some common mistakes people make with emergency funds, so you can avoid them. Mistake number 1 is keeping your emergency fund too accessible. I mentioned keeping it separate from your checking account, but some people go too far the other way and put it somewhere they can't access it quickly, like a certificate of deposit with penalties for early withdrawal. You need a middle ground, separate enough that you won't spend it casually, but accessible enough that you can get it within a day or two. Mistake number 2 is using your emergency fund for non-emergencies. That vacation you really want? Not an emergency. The big sale on furniture? Not an emergency. Black Friday deals? Definitely not an emergency. If you dip into your emergency fund for things like this, it won't be there when a real emergency happens, and you'll be back to square one. Mistake number 3 is leaving your money in a zero-interest checking account or a savings account earning almost nothing. Yes, your emergency fund shouldn't be invested in risky assets, but that doesn't mean it should earn zero interest. With inflation constantly eroding your money's purchasing power, you want at least some interest working in your favor. Take an hour to research high-yield savings accounts and move your money there. And mistake number 4, the biggest one, is not building an emergency fund at all because it feels too overwhelming. Look, I get it. When you're barely making ends meet, the idea of saving thousands of dollars sounds impossible. But remember, something is better than nothing. Even if you can only save $20 a month, that's $240 in a year. And that $240 could be the difference between handling a small emergency and going into debt over it. Let me recap the key points here, because this is important. An emergency fund should contain 3 to 6 months of your essential expenses, not your income, your essential expenses. Keep it in an accessible, interest-bearing account, like a high-yield savings account, separate from your daily checking account. Build it gradually using automatic contributions, starting with a small goal like $500 or $1,000. And remember, this money is only for true emergencies, not wants or planned purchases. Before we wrap up, I need to be clear about something. This video is for educational purposes only. It does not constitute financial advice. Everyone's situation is unique, and what works for one person might not be right for another. Always consult with a qualified financial professional for personalized guidance specific to your circumstances. Your emergency fund is your financial safety net. It's what stands between you and financial disaster when life inevitably throws something unexpected your way. And trust me, life will throw something your way. The only question is whether you'll be ready for it. Start building that fund today, even if it's just with $20 or $50. Your future self will thank you.